Decision, as the Chinese call it, the JD, of the third plenum of the 18th Central Committee was, in my judgment, a very well-researched, a very well-prepared policy blueprint for the transformation of the Chinese economic growth model. It had been the subject of enormous work over some years, and on the core questions, though, that is, the resolution that the market should be the central determining factor for the future growth and development of the Chinese economy, the centrality of consumption as a future growth driver, the centrality of the services sector, the centrality of a carefully managed urbanisation process, as well as the centrality of the reform of state-owned enterprises and their pricing structures. I think, as an overall blueprint, it's pretty good. On the implementation side, 12 months into that process, of course it's tough. You've seen some decisions taken, including the decision to increase the tax rate paid by state-owned enterprises back to the government from 15 to 30%, implemented over time. You have seen other initial decisions on financial sector reform, for example, the announcement of the Shanghai experiment. And you've seen a number of such measures like that. But I think it's fair to say that there's an internal debate within China itself as to whether the pace of reform implementation has been as rapid as it needs to be. And secondly, always constrained by, frankly, the ups and downs of the business cycle. And every time there's a down, the clamour of voices to apply the stimulus foot to the pedal becomes very loud, whether it's through monetary policy interventions or whether it's through fiscal policy stimulus or whether it's through other administrative interventions in the economy, all of which have a problem, which is that they get in the road of the systematic implementation of programmatic reform designed to have better price allocation in the economy over time. So the jury's still out. Blueprint's good, partial implementation, some criticism internally about whether it's gone fast enough, and always with a degree of compromise given, shall I say, the difficult state still of the global economy. Well, I think it's really important to take the economy down to its most basic elements of analysis. For example, let's just look at the drivers of final demand in the Chinese economy, because the question on everyone's lips around the world is what is the sustainable level of Chinese economic growth into the future, given it's so flat in Europe and going backwards. It seems to be going backwards in Japan. It's half reasonable here in America, but globally it's fairly thin. So, looking at the Chinese economy, what's driven this economy forward so far? Well, number one, a pretty buoyant labour market. Number two, you've had also large levels of capital investment, fixed capital investment, both public and private, but primarily public. Three, you've of course had the contribution of net exports to the Chinese economy through historically buoyant export sector, but that's run into trouble since the global financial crisis. But the contribution overall of consumption has been modest. Therefore, looking ahead, what I really am concerned about, and I think the Chinese leaders are concerned about, is whether all the policy instruments being deployed to lift the level of domestic consumption actually succeed or not. Because with net exports coming off as a driver of growth, and with fixed capital investment probably starting to come off, then that slack has to be taken up by consumption. And so that, I believe, is one of the most difficult areas to bring about success. Now, on the other side of the equation, on financial sector reform, I think the Chinese are managing well dealing with the balance sheets of troubled individual financial institutions. I think there's a rational process which identifies which are to be privatised which are to be rationalised in terms of selling off of bad debt on their balance sheets. I think it's unlikely that we're going to see a systemic financial crisis, not just because of too big to fail considerations, but because they have a very programmatic way of working their way through this. Of course, that's a necessary precursor to greater financial market liberalisation. You've got to make sure that the financial shop is in good order. So I'm more bullish about that than I am perhaps about the transformation of that part of the growth model in terms of consumption.